back to another video. So in this video, we're going to be moving on and slowly start going more in depth on the market itself. So what we're going to be covering today is supply and demand. Now, all we're simply going to cover in this lesson is supply and demand and the basics of supply and demand. Now, when it comes down to supply and demand, this is going to be the foundation of our trading methodology, meaning that behind almost every single trade that we take, supply and demand is going to be one of the top reasons that we're going to be taking that trade. Now, why trade supply and demand is very simple. It's simply because that's how the market moves. There's lots of different strategies out there, that you could potentially learn how to trade. A lot of them may not make sense, but supply and demand has always been the one strategy to me that I found the most profitable, simply because that's how the market moves. Now, I can cover the reasons why I'm going to be trading, why we're going to be trading supply and demand, such as risk to reward, such as it gives us better areas to place orders, along with where we could take our place our take profits and our stop losses. Along with it gives us better price action signals on where we could take the trade. There's so many reasons on supply and demand and why we could trade, or why we should only really be trading supply and demand. But again, the main reason that we're going to be trading supply and demand is simply because that's how the market moves. Now, let's just kind of get right into it. What supply and demand is that when there are prices in the market that are more desirable for both the buyer and the seller. For example, let's say gold is trading at 1,700 from its original highs at 2,000. That is going to be a more desired price for the buyer than it is going to be for the seller, because it's already at a discount. It's already cheap, right? So when we talk about supply and demand, and when we're talking about desirable prices, the lower the price range gets, meaning if gold is trading at 2,000, right, and it starts going from 1,900 to 1,800 to 1,700, price is going to increase on desirability for the buyer to actually start taking buy orders to look for that asset, being gold, to continue to go back up so he can make a profit. Now, the same thing is for the seller, just simply vice versa. Let's say gold was at its original highs at 2,000, and now gold is at 2,001, 2,002, 2,300. Price is gonna start getting more and more desirable for the seller to look to actually sell gold to make a profit. It's very, very simple. Now, let's take this for an example on how supply and demand works. So let's just say you're in the shoe game, right? I'm just gonna throw a random example out there, right? But let's just say that you're looking to buy this one pair of Jordans that the retail price for that specific shoe is $100, but you see price maybe had gone down a little bit, whatever the case might be is, or let's say you were able to get a deal for buying 80% of the supply for the shoe. You were able to purchase 80% of the shoes for $90, right? Automatically, when you buy 80% of what the supply of the shoe is, right, the demand for the shoe is going to increase because there's a lack of supply. The shoe, in theory, is going to be more rare because there's not as many shoes on the market available anymore. So the shoe itself is going to increase in value. So now let's say you sell all your shoes for, again, all 80% of your shoes that you own for $120, which you purchased at $30 a shoe, or you purchased at $90 a shoe. You're simply going to make a $30 profit. And again, you buying the shoe at $90 is more desirable for you to buy the shoe at that price than it was at $100, because you're able to make an extra $10 profit per shoe that you own. And it's as simple as that. There's no need to get any more in depth into it. Now, you could look at really any market in general. Let's just say, let's just take a look at the real estate market, right? Let's just say the real estate market is down. It's down 10%, and a house that you saw selling for $1 million is now selling for $900,000 you're going to be more inclined to buy that house because it's cheaper. And when the market goes back up, hey, instead of making an extra 5% or whatever the case might be, let's say the value of the property itself goes up to $1,000,001, you were able to cash out almost a $200,000 profit because you bought at a lower, more cheaper price, right? So I'm going to go back to here. It's literally the same exact thing. And you can look at what's going on nowadays. I'm going to give you some real life examples of supply and demand. You can look at what's going on nowadays with the car market, inflation being at all-time highs, along with, things with the pandemic and the vaccine and everything else. Every single market has been going like crazy. The stock market has been going up like crazy. The real estate market has been going up like crazy. And the car market itself has been going up like crazy. So I'm going to give you guys this example with one of my cars being the Lamborghini SVJ. I purchased that car about 8 months ago for, I want to be more accurate, let's say 6 months ago, for around $680,000 was the purchase price, right? Nowadays, with inflation and everything up, everything else going on, the car market has gone up significantly. Along with that, more and more cars are being sold every single day, and the SVJ itself is a limited production car. My car is one of 800 manufactured. I don't know how many here there are in the United States, but I know my car is one of 800. So I bought that car for, again, $680,000, right? Now that the car market and everything, along with the real estate market and inflation is going on, right? All of those cars, again, over time have been being manufactured and continue to be sold. So the supply of the cars that Lamborghini offers now is going to be a lot less significant than what it was previously when the car first came out. And as more and more cars are being sold, the demand is increasing on those cars. So nowadays, if you look at the retail value of the car itself, right, you can go online anywhere and look at the price. I went online, I looked at the price of what my car is selling for now, and it could sell for anywhere between $800,000 to, let's say, $900,000 was the most expensive ones that I've seen. So I could potentially make a $120,000 to $200,000 profit on my car because I bought it before the demand for the car increased, when there was a lot of supply of the car. And it's as simple as that. And that's a real life example, right? Now, that was the basics of how supply and demand works. So when price gets too high, market makers typically, and this is for the example of the market, right? Of any market, stocks, currencies, whatever the case may be, as cryptos. When the price gets too high, market makers look for a desired price to start liquidating their buy positions, which causes the market to sell off. Because you have to remember, for every single buyer, there has to be a seller willing to sell you that contract. So when the case happens where price is too high, let's say gold hit 2,000, right? Again, there's going to be sellers looking to take sell positions at that price, along with buyers looking to close their buy orders, giving the sellers their positions or those contracts, right? That's going to cause a sell-off in the market. Now, the same thing for vice versa, right? When price gets too low, market makers look for a desired price to start liquidating their sell positions, which causes the market to rally. And again, there's two sides of the spectrum. When price is getting too low, like 17, 1800, this is going to be on gold, right? The seller is going to be like, okay, I sold gold at 2,000, and now we're at 1,800, so I could potentially make a 20, 30% gain, whatever the case might be is, and I'm looking to close my sell position. At the same time, for the people who didn't sell gold then and there, right, the buyers are looking at, hey, gold is at 1,800, 1,700. I'm going to look to buy gold now and wait for gold to come back up to 2,000 to possibly look to close on my sell. And that causes the market to go up. It's all supply and demand. When supply drops, demand increases. When demand drops, supply increases. Now, the law of supply and demand. The higher the price of the asset is, the more the supply will increase. Vice versa again. The lower the price of the asset gets, the higher the demand will increase. Literally, you could just kind of grab this and put a weight on each side, and it's just as simple as that. Supply and demand is a very simple concept. Now, here's some key notes that you should maybe consider, right? Market makers are looking at the bigger picture, and this is when it comes down to trading and, taking supply and demand and putting it into the trading perspective. Market makers are looking at the bigger picture, meaning the higher time frames such as the daily and the weekly time frames. And I wanted to mention this because there's going to be, again, scalpers, day traders, and swing traders trading different time frames. When market makers come in the market, they're the ones moving the market in the direction that they typically want to. And again, market makers are waiting for or looking at these higher time frames, waiting to get in on the best deal possible. And they're not looking at 5-minute time frames. It doesn't really work that way. And again, it works with the overall bigger picture being the daily and the weekly time frame, right? Now, again, when demand exceeds supply, it goes up. When supply exceeds demand, price goes down, and it's literally as simple as that. And I just wanted to break down supply and demand so you guys understand why this trading methodology works. In the next videos, we're going to be covering supply and demand and actually implicating it into our chart so we could see where these major supply and demand levels are so you could find future trade opportunities. Yo, what's good, everybody? Welcome back to another video. So in today's video, what we're going to be going over is supply and demand. Now, again, supply and demand is going to be the foundation for our trading methodology, for our trading strategy. Most trades that we take are going to be based off of supply and demand. So we're going to be pretty much just marking up supply and demand on the charts, and we're going to be going over a lot of supply and demand examples. So let's just kind of cover the basics first before we start actually drawing it on the chart itself. Right, so what I'm going to do is, let's just say that this is the chart. Let's just say this is the price action chart that you're looking at. Let's just say you see price doing something like this, right? So now I'm going to write down here on the screen demand, which we could do something like this, which equals, we could do this. And then I'll write one more thing out on the screen here. So now, when it comes down to supply and demand and us actually setting our levels, demand is going to be support. So whenever price is going down and it hits a level of demand, you can expect it to go in the opposite direction. And supply is going to be the roof, and it's the complete opposite. So supply is going to be resistance. So you can think about when price is going up and it hits a resistance level, that is a level of supply. When price is going down and it hits a level of support, that is a level of demand. Now, when trading supply and demand, why we want to only really take trades at supply and demand levels is simple. If I were to take a buy position, let's just say, so I'm going to use this tool, which I'm not sure if you guys are familiar with the tool. Maybe not, depending on where you are in the course. But this is going to be a rough draft of an actual trade. So let's just say I want to buy right here, and my target is resistance, and my stop loss is under supply. Notice the risk to reward ratio is a 0.68. So if I'm risking in this situation here $100 on this trade, right, I have an $100 risk for a potential $68 reward, which doesn't make sense at all. In trading, you want to risk $100 or whatever you're risking to make double that. So in this situation, $200, and this is going to be another way that we have an edge over the market, is by consistently making more money than what we actually lose. And by taking random trades and not taking trades in supply and demand levels, you're going to be really minimizing your edge against the market. You're going to be killing your risk to reward ratios. And one of the main reasons that we take levels at supply and demand are, one, because it's a high probability setup, and two, we have an area to set a stop loss and to take profit. So now let's just say we were looking to buy at this area down here, right at the supply and demand level. What we can do automatically is lower our stop loss to under the level of demand, and we could target our supply level. And notice our risk to reward ratio is now a number 4, meaning that we're risking $100 on this trade to potentially make $400. And now we have a way better edge over the market, increasing our long-term profitability, which is more important than a short-term trade. If you see the market doing something like coming down and you expect it to come down to demand, don't just take a random sell in the middle, kind of floating here, right? Again, you always want to take a level or a trade at a supply and demand level. Why? Because again, it has an area for you to place your stop loss and it protects your order. Because if I were to take a trade here and my stop loss is here, I know that if price starts to come under my demand level and hits my stop loss, then I'm wrong and I automatically want to close out of my position. And this is how we cut losers short, because price can do this all at once, all day. As long as it maintains above our level of demand here in this buy situation, right, the trade is still valid. It could be 4 days later and price still be trading above demand and the trade still be valid until you either see a big break to the upside where you'll make money, or you'll see a big break to the downside and you'll get stopped out of your position and lose money on that specific trade, right? So that's the basics of supply and demand. Now, what we're going to be going over is how to actually place them on your charts so you can identify these supply and demand levels. And the only way you're going to be doing that and getting better at it is by practicing. So what we're going to focus on is levels of liquidity where we have major liquidity. And what I mean by that is simple. When you see price come down to a level and have a big reaction, meaning that price moves away from that level very quickly, and the bigger the move is from that level, typically the stronger that level is going to be, right? So if price does something like this, it's a very strong level. If price does something like this, it's still a very strong level, because once it broke under, notice how it came right back up and then continued to go in the opposite direction right away, versus price doing something like this. Right? So it's pretty simple. The concept itself is simple. Now, everyone's going to draw their supply and demand levels very differently. I try to be as accurate as possible. One thing that you could do is simply draw zones. So we could draw a zone like this, where notice how, again, it's supply and demand. So I'm going to draw my level like this. So notice how we have, I'm going to mark this off here. Notice how here we have demand, because again, price is going up, hit resistance, rejected, that's demand. Notice how we have supply. Price broke above, came back down, resisted, and rejected, and continued to trade higher. But again, it comes back to the same example of the impulse. Price came right up, big reaction to the downside, broke above, came right back down, retested, big reaction to the to the upside here in this situation, right? And then again, we can continue. Notice how we have supply, or demand. Notice how we have demand here again. And notice how each time price came in the zone, it reacted right away and went in the opposite direction fairly quickly. Also, this is the weekly time frame. We want to draw our main levels of supply and demand based off the weekly and the daily time frame. So that's going to be the first level that I have marked off here for my supply and demand level, right? Now, what I'm going to do is I see this area here being a potential area. I'm going to draw this out to be like this. Here's another supply and demand area, right? If we look at it, here we have demand, or here we have supply, here we have supply, here we have supply, and then here we have demand. As simple as that. So now what I'm doing is marking off areas where I could potentially take a trade, right? Notice how price came to the zone, immediate rejection. Same thing here. Notice how price came to the zone, immediate rejection. What I'm going to do is also lock this as well. So I'm going to modify this one a little bit to be like this, because again, I don't want to make my chart all, I don't want to say clogged up, but I don't want my chart to have too many random lines and levels, right? And now what I'm going to do is look for my more major levels on the daily time frame as well. But now what I'm going to do is kind of keep marking off my levels of supply and demand, my more major ones, which the first one I see is right here. I can mark this off here, which this one's a pretty big one. I'm going to mark that off there. Right, in this situation, notice how price came up, immediate rejection, came up, immediate rejection. And now price is kind of going up towards it. So what can we expect? We can expect price to go up and have an immediate rejection. Now, if price breaks above, we can wait for it to come back into it and then look to take the trade higher, right? So this is how we start looking for these high probability setups. And all I'm simply gonna do is keep marking off these major levels here. So here's another one, right? Here's another one right there. And that's it. These are the major supply and demand levels that I'm gonna have marked off on my chart so I could plan future trades. And all we're simply doing is trading in between these levels, right? So let's say if price were to break under here, my next target where I would look for price to go in the long term would be down here, right? If price were to break above like it did here, my next target in the long term would be way up here. Now, you know what, before we get into this example, let's go down to the daily time frame, because typically on the weekly I have my more major ones. Now on the daily I'm going to mark off my more minor levels, but we could see how things change a little bit, right? So they're still the same levels, they're still the same value levels, right? But notice how here price broke under and it looked like it was a clean break under, right? But notice how price closed up above there. If you go to the weekly time frame, you could see it maintained above the entire time. So you always want to confirm your weekly levels with the weekly close before you make any other decision, right? Now, what I like to do on the daily time frame is mainly use horizontal lines. So we're going to use a line like this one, right? So the first level that I see is right about here, 1830. I'm going to make this white. And what I'm going to do in this situation is I'm going to leave it as it is and I'm going to lock it. If you can make any adjustments you'd like to be as accurate as possible, right? In this situation, I'm going to put it here, right? Because if we look at it, which by the way, go into your settings, make sure the visibility, you can copy all of my settings, but the style, you want it to show price. Then we're going to go to text, text alignment bottom right, and then you can add daily if you'd like and add the price. That's a little bit unnecessary, but what I like to do is add 1830. I already know it's the daily just because I'm using a horizontal line. Right, so I know when price coming, we're coming to the 1830 resistance, right? So this is the first one I'm going to do, because look at what happened every time price came to this, or the market came to this price. Rejection, rejection, rejection. We know that this is a level of demand, a level of supply, right? Now, staying on the daily time frame, right? Let's look at what price is doing, how we could potentially plan this trade. Notice how price broke above immediately, right? Now that we've broken this area, the best thing to do is wait to see if price will come back down into this area where we can look to take a buy to the next level, being here and being here, right? So whenever a level of supply or a level of demand breaks, you want to wait for price to retest that level, confirm that that level is broken and held and continued in the opposite direction. So let's say price were to come down to this zone and break under, meaning that we're starting to trade lower and candlesticks are closing lower. Wait for price to come into the zone and then wait for price to continue to move in the opposite direction, right? That's a nice trade opportunity there. That's a high probability setup. It's as simple as that. Especially when you have more major levels like this one, the probability of price retesting that level is very high, because you want to think about these supply and demand levels as like a tug of war, right? Or you could think about it as a battle, however you want to think about it, right? Just keep in mind that one time sellers held this level as a level of resistance. Look what happened every time price came to this level. immediate rejection in the opposite direction. Now that buyers have broken under this level, you can think about it as sellers are always trying to bring price down, right? Again, when it comes to supply and demand, there are price levels that are more desirable. Right now, price may be a little bit expensive to buy because price went all the way down from 1759 to 1877. So buying is a little bit more expensive for the bigger players, right? So what's more desirable, for them to kind of buy in the middle of no man's land where there's no real level of support and resistance, or to wait for price to come back to 1830 to look to buy, right? Let's say price does come to 1830 to look to buy. Look how long it took buyers to break 1830, right? This candlestick, or the first rejection, happened July 15th. We're currently trading right now in November 17th. So it took them a few months to be able to break above 1830. If it took them that long, don't you think it would be best for you to wait to see what would happen at that level? And don't you think buyers would want to actually hold above 1830? Right? So these are all things that you have to think about when actually looking to take a trade. Right? The best setup for you in this situation here would be to wait for price to come to 1830 and look to take buys from there. Again, they fought so hard to break 1830, they're going to want to hold 1830 no matter what. And let's kind of continue here. So again, we're looking at all current relevant price and marking off our levels based off of relevant price action. So another level that we can mark off would be, I want to say this level right here. I'm trying to do this with as much accuracy and precision as possible. So the best other area to mark off would be right here. And this is going to be 1794-ish. I'm going to try and make some adjustments because I saw this level because of right here and right here. So I'm going to make adjustments as best as possible. So I think putting it at 1795 would be what makes the most sense, right? Now, you don't have to ask yourself, oh, why 1795 instead of 1790? It's all, at the end of the day, personal preference and what your eye sees. Me, I see demand, supply, 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 demand, demand. I see a little bit of consolidation here, but then again, supply, supply. And then, I mean, it could be demand, but that wouldn't make too much sense overall, right? Or in more simple terms, support, resistance, resistance, support, resistance, resistance, support, resistance, resistance, right? So it's basically a level I see price rejecting a lot. And another level that stands out to me right away would be this one here, being 18. Let's put it down here at 1870 would be best, right here. Again, I'm going to lock it out of my text. 1870. Why? Again, you always want to look left when setting up your levels. Structure will always leave clues for you, right? I could have done one right here, which it would also make sense, but what I see is this. So again, what we're doing is trading in between these levels of supply and in between these levels of demand, right? So let's just say that price is trading right here, right now. If it were to come under and break under this zone that I have here, then I'm going to look for price to come down to the next level, which would be right here, which I could mark off here as well. And I'm going to mark off here just so I can have it on my chart. Right, because again, there's levels on the daily and then there's levels on the weekly. This is why we're separating our charts and making it as clean as we possibly could while having as much detailed information as possible. So this is going to be 17, let's leave it at 1720. We're going to go to coordinates and modify the price to be 1720 flat and see what that looks like. It's a little bit too far, so I'm going to bring it up a few. Let's put 1722 right there, right? So all I'm doing is trading in between these levels. Is literally all I'm doing. So if price were to break under 1720, I'm gonna look for price to come into my zone at 1685, right? Now, if price were to start trading higher as it's doing, notice the break of 1795. If price were to break 1795, then I'd look for price to come all the way to 1830. If price were to break above 1830, then I'd look for it to come all the way to 1870. If price were to break 1870, then I'd look for it to come up to 1900, where we have another level of supply and demand in here. Now, if price were to break under 1830, I would simply look for it to come to 1795, right? But in this situation here, I'm going to wait for price to come down to 1830 and then wait for price to look to target 1875. So what I'm waiting for is something like this, for price to do this, right? And again, I'm looking to enter here. I'm going to place my stop loss somewhere down here under the level, and my target is going to be my next level. It's literally as simple as that, right? So that's really it for placing your supply and demand levels. I want you guys to go on your charts. I want you guys to practice placing your levels on the weekly. I want you guys practicing to place your levels on the daily time frame. In the next video, we're going to be going over our more minor time frames, which is going to be the 4-hour time frame, and it's also going to be the hourly time frame. So I'll talk to everybody in the next video. Yo, what's going on, everybody? Welcome back to another section of the course. Hopefully you guys have been enjoying the course so far. Hopefully you guys have been taking a lot of notes. But anyways, in this section, we're going to be going over support and resistance, which again is a very similar concept to supply and demand. Let me kind of just zoom in here so you guys can probably see it a little bit better. It's a very similar concept to supply and demand, except we're going to be using this on our lower time frame. So any of you scalpers, intraday traders, this is going to really apply more to you. Supply and demand is going to be mainly for swing traders, even though we can take intraday trades from these supply and demand levels. But generally, they're all the same concept. So typically, when we talk about support and resistance, we're going to be using our support and resistance levels and marking them off based off of the hourly time frame and the 4-hour time frame. Now, we're going to be using our main levels of support and resistance, and we're also going to be end up learning how to draw random lines of support and resistance for more minor levels and whatever the case may be. So, like I said, support and resistance is practically the same concept as supply and demand. It just works on smaller time frames. So support and resistance, you can mark them off anywhere between the 5-minute to the 4-hour time frame. Typically, supply and demand is going to be mainly for a daily or a weekly time frame is where we're going to be marking them off. Because remember, you want to, or supply and demand works off of, obviously, supply and demand, but the bigger hedge funds, banks, institutions are going to be the ones who are trading off of these levels, and there's going to be support and resistance levels within these supply and demand levels, and you can pretty much take a trade within those major supply and demand levels and take trades off of the more minor support and resistance levels. So they're predominantly used for intraday setups, and again, they're great for the best buying and selling opportunities you could potentially get within the markets. They're the ones that make the most sense. They have way more pros than breakout setups. And again, that's because you have a great stop loss and take profit placement. It's super easy and shouldn't be too difficult to set your stop losses and take profits. So again, the overall concept is the same. You want to actually end up buying at support and selling at resistance. Now, there's going to be 3 forms of support and resistance, and there's going to be 3 forms of rejection. There's going to be your touch, there's going to be your gap, there's going to be your overlap. So, like I said previously, you have your touch, you have your gap, and you have your overlap. The example here in black is going to be an overlap, or a touch, my apologies. The example in red is going to be an overlap, and the example in yellow is going to be a gap. So notice how I drew my line of support and resistance right here. Now again, support and resistance should always be considered as an overall zone, but for the example, of the video, I kind of just have a line. Now personally, when it comes down to my trading, I like to be as accurate as possible with my support and resistance levels. And this is why I kind of just make one horizontal line, and this is where I place my level. Now, we're going to go over placement in the next following sections, but just so you guys can get it. So here is the touch, Notice how price just touched it and we had a big rejection to the opposite direction. And then same thing kind of again here. We have a little bit of an overlap, but you know, it's pretty much a touch. And then we have an overlap here. Notice how the candles kind of closed over the level of resistance in this case. And then price ended up coming back down and closing back under. With this candlestick here, that's going to be considered our overlap. And then here's our gap because we simply just gapped the level of resistance. Notice again how there's a gap in between the resistance and the wicks here before price moved in the opposite direction. Now, let me show you guys what a broken level of support and resistance looks like. So like I was saying previously, support and resistance is an overall zone. So I drew my level from the close of this bullish candlestick here, the lowest close, to the lowest low here, which is this wick here. Notice how we had some consolidation here, and then price ended up coming back down and then rejecting, moving the opposite direction. Now, a break of resistance, or in this case support, is notice how this candle came all the way down, closed under support, and then this candle closed under support here. This is the two candle confirmation that we need for a broken level of support, and it's pretty much the same thing with resistance. Two candlesticks have to actually close over the level of resistance. Now, this is what pretty much a fake out kind of looks like, where you have a candlestick close above and then you have the confirmation break with this candlestick here, but the following candle closes right back under, making this level of resistance actually rejected there. So this is going to be what a fake out looks like. Now, hopefully you guys do understand the basic concepts. Again, this is a very simple concept, but again, you know, support is going to be used as your floor. And when we're trading support and resistance, typically, like let's say we're going to take an entry here after this candlestick right here, and we decide to press buy here. Our stop loss is going to be going under support, and our take profit is going to be resistance, right? Giving us a great risk to reward ratio, along with a better area to place our stop loss, because support is what's protecting our stop loss from actually getting hit. Now again, everything works in probabilities. Just because you buy at support doesn't mean that it will always 100% of the time reject it, right? Sometimes it may just break, sometimes it may reject it a little bit and then break. You know, again, this is a game of probabilities. More importantly, trading isn't just technical analysis, it is managing risk. I will see everybody in the next section where we're going to be pretty much drawing our levels of support and resistance and how you can place them with accuracy. Alright everybody, so pretty much what we're going to be doing is drawing our levels of supply and demand, our more major levels on the weekly time frame and then the daily time frame. I'm going to be showing you guys how I do it and how you can potentially do it as well. At the end of the day, how you draw your levels is up to you. What's more important is how you identify these levels. Now, when it comes to me, one thing that I like to do when it comes to the weekly time frame, then we'll work our way down to the daily, is look for the more major rejections. So notice how price just hit this price point here, then had a huge move to the upside. Also notice how we have an initial rejection here, we have an initial rejection of support here, and then we had a big move to the upside. So when I look at price, this is what I'm currently seeing. Huge move to the upside. Notice again, another rejection. This is what I see right here. Huge move to the upside. So now that I've identified this area as being our potential support and resistance level, our main level of supply and demand, what I'm going to be doing is putting a random horizontal line here. I'm going to be making this black, and I'm just going to be looking for the best possible price to put this at, where I have the most touches and what makes the most sense to me. So 1687 is going to be the level that I decided to have the actual horizontal line marked off at. Now what I'm going to be doing is just simply modifying this to 1680, keeping the round numbers there. See how that looks. You know, it's okay. I'm going to check it on the 4-hour time frame. Yeah, I'm going to keep it just like this. So 1680. Now what I'm going to be doing is going to settings. I'm going to lock it. And then I'm going to add a text to this, calling this my weekly level. Weekly 1680 supply and demand. Right, so there we go. So I have my first level marked off there on the weekly time frame. Now what I'm going to be doing is I'm going to just simply continue, which this could be another level right here, but this is probably going to look better off on the daily. 1748. So I'm going to mark this off here as well, because notice, actually I'll explain that in a second. I'm going to mark this off here as well. And I'm going to, what if I put it at 1650, which should be 20 pip difference. I don't really like it, kind of lower it. Let's just do 1648.